Hello and welcome again to Charles Kelly Money Tips. Great to see you all. Thanks for joining me on Facebook Live, and thanks to all the groups who tune in, and thank you for listening to my podcast on iTunes and Stitcher, and also on my website moneytipsdaily.com. Great to see you all, and I'm reporting here from London, as you know, where it's cold. It was a cold, crisp, sunny day. I was up in London today viewing a property for a client of mine. And yeah, it's cold, but it was sunny. And today is the last day of campaigning for the elections in the UK. And tomorrow they'll go to, we will go to the public, and the public will decide who is going to be the next Prime Minister and who's going to govern the UK for the next 5 years, or it could be shorter if other elections are called. And the slightly worrying thing for the markets is that the lead that the Conservatives had has been narrowed down, and it could be, there's a chance that it could be a hung parliament, which means that no parliament, no particular party has overall power, and you have what's called a hung parliament, which means that it's like a coalition, or and everything has to be agreed between the parties. But if you look at the various parties, Conservative, Labour, Liberal, SNP, the Welsh and the Brexit Party, they don't seem to really agree on much together, and so that could be a bit of a stumbling block for any meaningful legislation in the next parliament. And these coalition governments generally don't last very long, and they have to go back to the country to see who will be the overall winner. So that would make markets unsettled. And in fact, UK growth forecasts have slowed down to just over 1%, 1.3%. And things have slowed down in the last year. I've certainly seen property prices slow down in the last year. And that's partly because of the uncertainty around Brexit, the elections, trade wars with China, which has stepped up again. There's a trade war going on. Even the WTO, we were supposed to leave the European Union at one time on the WTO rules, and it looks like they could be broken up if America do not appoint judges to the WTO. So I don't think that's going to happen, by the way, but everything's looking a little bit uncertain, and that's why I think growth is usually slow in these times. And American interest rates are low here, and yet that's still not stimulating the economy enough. Although in the long run we are better off now than we've ever been, but things have certainly stumbled along this year. So we shall see what happens. Now, the other day I talked about these mini bonds that a firm had collapsed. Mini bonds are a form of it can be arranged as an ISA, where you think you're just getting an ordinary ISA, but it's paying you more money. What in fact you're doing is lending that money to the organisation, who then lend it out at higher interest rates, and that's why they're called a mini bond. And a lot of people thought they were just like an ordinary ISA. In fact, sometimes people have asked me, should I take this ISA out? It's 8%, or should I take this one out? It's 2%. Well, the 2% is probably in the bank, safe and secure in a deposit-based ISA. And whereas this mini bond is not quite so secure, as it's turned out that this company collapsed, leaving 12,000 savers out of pocket. So you've got to be careful. You're not comparing apples with apples. Just like if you have an ISA that invests in shares, you know that it's an equity-based ISA. The money is going into shares, and the value of those shares could go up and as well as down as well as up. So, whereas in a deposit-based ISA, you might be earning a lower interest rate, but the risk is lower because if the bank lend that money out and they lose it, they have a bad debt, they're not going to come back and take it off of you, which is what can happen when you go into these types of mini bonds or peer-to-peer lending, or you give your money to a crowdfunding company because they're going to pay you 6%. To me, 6% is not enough to cover the additional risk that you get from lending money to people who are then going to lend it out. And we don't know how strict they are, how rigid they are, how robust their underwriting is. And they're going to lend it out to people to do property developments. And, okay, it could go one way or the other. It could go well, it could go badly. Lots of things can happen in the development. So I don't think 6% is more, enough return for me to risk my money in that way. Yes, some of the companies have returned good money to people. They've always returned money. Others haven't. Others have gone bust. Because think about it, if someone can get their money from the bank, why are they going to crowdfunding? Because perhaps they can't get the money from the bank and they're going into crowdfunding and peer-to-peer because the bank are too strict with them. So that's just my opinion, by the way. You'll have to decide yourself and take your own financial advice. This is just what I'm saying I do. Now, what makes me qualified? Well, I'm the author of the book Yes, Money Can Buy You Happiness, which is about how to manage your money, how to be happy with your money. I've also spent 25 years in financial services before retiring from that industry, and I've seen thousands of people and met thousands of people and gone through their financial situation in much detail, in more detail perhaps than they would give to their families. They wouldn't tell their families the things that they would tell a financial advisor, like I'm in big debts, like I've got county court judgments, like I've got debt problems. So I think I'm a little bit qualified to talk about this. Now, what I want to talk about today is credit agreements, because a lot of people sign credit agreements without signing them, without reading them properly, and they just sign them. A lot of people sign them without understanding them. And then when later on down the road they say, well, you didn't explain this to me, but it's there in black and white. And this is particularly true of the car finance industry. Now, 90% of new cars now are bought with some sort of finance. And many of these are bought on contract hire purchase agreements, HP agreements, and I'm going to explain a little bit about the difference, and various other forms of agreement, dealer finance, manufacturer's finance. And this is why a lot of people are driving around in brand new cars. Before, people would keep their new car for years and years and then maybe trade it in after 5-10 years for a new one. Now, people are changing their cars every couple of years because of the easy credit that is available. And quite frankly, somebody, people driving £50,000 cars would normally not be able to drive that car and have that car were it not for the finance and particular forms of finance as well. Now, HP, a hire purchase agreement, is where let's say you're buying a car for £20,000, you borrow £20,000, you pay back £20,000 over the term with interest and charges, and then the car is yours. Now, the payments are usually dependent on the interest rate and the term of the loan. Now, a contract purchase agreement is slightly different. This is where you are not borrowing the full amount that the car is worth at the time. And say on a £20,000 car, you would be paying back a loan of £12,000. So the payments would obviously be lower than paying back a loan of £20,000. And then at the end of the term, you have this what's called a balloon payment of £8,000, right? 12 from 20 leaves 8. And you would either pay that £8,000 off to have the car and own the car, or you would give the car back and then they would probably offer you a new deal. And this is what a lot of people are doing. So it's like a deferred type of payment where you're not paying what you would have paid on a straightforward hire purchase where you're buying the car and the car is yours. Now, many people like these deals because they say, well, the car is depreciating in value anyway. Why own it? Rent it and not own it. And there is some argument for that. But a lot of people are confused by these agreements. And I was listening to a Radio 4 show, Money Box, and people were phoning in and saying that they were not told this and were not told that. One person said that she didn't realise that there was a limit on the mileage of the car. Now, clearly, if the company are effectively, they're almost renting that car to you for a term, and you're paying back interest, you're paying back loan, they're taking that car back. So if they don't have a mileage limit, then what's the point of it? The risk would be too high for them. You could get a car and go and become an Uber driver and do 200,000 miles. And here's your car back. And they said, well, no, it's not worth anything now. You've run it into the ground. You've done too many miles. So they all have a limit of usually 8, 10, 12,000 miles. And then you would set your limit based on what you usually drive. And that would be reflected in the price of the agreement. For instance, if you said, well, I'm going to do 8,000 miles, they know that car at the end of that term would be worth more because you've only done, say on a 3-year term, you've only driven it for 24,000 miles. And they would set the price and the monthly payments at a rate commensurate with those mileage. But if you said, I'm going to do 12,000 miles, then at the end of the term, 3-year term, you would have done 36,000 miles. That's quite a big difference from, £24,000, and the car would be worth 24,000 miles and the car would be worth less. So they would set you a higher monthly rate. Now, some people are saying, well, I didn't know there was a mileage limit. Other people, however, have been hoodwinked and told they wanted 12,000 miles, and the salesman said, yeah, okay, that's fine, just sign here. And they found out that wasn't the case. They in fact had a lower mileage. But you've got to watch these things. You've got to really read your agreement. In fact, it's in my book. I talk about the 3 R's of money management. Read everything. Read your agreements. Read your bank statements. And I've said here in the book, I watch your back, watch your liabilities. I can't tell you how many people I've known have made a lot of money in their lives, sometimes millions in a single venture, but have ended up broke and with nothing. This is because they are careless and don't read things, or take too many risks, or borrow too much money and then end up with nothing. And remember, if you're buying a car, it's a depreciating asset. I put a quote in the book here from Sharon Lechter, who's the co-author of Rich Dad, Poor Dad. Assets feed you, liabilities eat you. Assets feed you, liabilities eat you. Assets like a property or a share that gives you a dividend, gives you growth, is feeding you. Assets or liabilities like a car is not an asset, it's a liability. It's going to cost you money all the time, and it will literally eat you. It will drain your pocket of money. So don't think of it as an asset. This is the problem with buying assets on interest rates, where you're paying high interest rates to buy depreciating assets. In fact, if you other people were complaining that for whatever reason they wanted to give the car back after 6 months, and the finance company said fine, but you've got to pay a £2,000 or £3,000 extra penalty charge. And so why is that then? Well, obviously the car is worth less than they've borrowed, and for the first couple of years, when the car has dropped in price as it's driven off the forecourt, your loan is there, but the car price has already gone down, so they will charge you an extra premium to give that loan back. Now, when you've paid back 50% of the loan, you can give the car back under the Consumer Rights Act. But at the initial point, when someone wants to give the car back, it will cost you money. And this is because it's a depreciating asset. If you buy a TV or a car or furniture on hire purchase, then it will literally eat you. It will drain you, because you're paying high interest rates for a start, usually quite high. I mean, I saw an interest rate the other day, 47%. It was, I think it might have been an American Express card or an American Express special card or store card. 47%. I mean, that is crazy to be paying those sort of interest rates, or even to be paying 25, 30% interest to buy stuff in shops, to get a store card and buy stuff that, once you bought it is already probably worth half what you paid for. And it's the same thing with car finance. So make sure you read all these agreements, make sure you understand them. Salesmen in car showrooms often are not qualified to explain things to you. They often don't know the difference between a simple interest rate and an APR, an annual percentage rate. They don't know the difference between what one agreement to another. So they don't know the difference between one type of finance to another. Now, you should be dealing with a business manager who does, but you do have some consumer rights. You do have a right to go back and challenge these things. But the best way of dealing with it, any finance agreement or any mortgage agreement, is to make sure you read it. I know it's difficult. I know it's difficult to understand, but get them to explain it to you. Make notes, record them even, so that you can be sure of what you're being told that it is correct. Because a car is like an emotional purchase, like a house. And in that moment where you just want the car, you want just sign here and you can drive off in your shiny new car. Here's the keys, just sign here. You're probably tempted to sign these agreements without really reading them thoroughly. And that's where the errors can be, extremely costly. Yeah. So make sure you're covering your back there. So some other financial news today. Yeah, I talked about these mini bonds, right? That a company had gone bust. And that turns out that the fraud office are looking into them, the serious fraud office are looking into this company, because the directors in the last year or so have drawn out from the company £20 million. £20 million they've taken out for themselves. And no wonder investors are left high and dry. And these are the risks you're taking by going into these deals that look too good to be true. And the old saying, if it looks too good to be true, it probably is. So that's sad news for the savers. But it just shows you what some of these unscrupulous directors can do. They've literally ripped the money out of the company and left investors high and dry. So just watch yourself there. Other news, as I said, that the markets have kind of slowed down. we've got the election tomorrow, and the country will decide where we're going one way or the other tomorrow. So I'll be back again tomorrow to report. We won't have the result tomorrow during the day because the election will go on all day, and then there will be a count in the evening, and we won't hear anything probably until after midnight, or maybe even Friday morning if you're going to bed and sleeping. So then we'll know what's happening there. We'll see. I just hope we get one or the other, because if we get a hung parliament, then that's just more uncertainty and more stalling around and not knowing whether we're going to go through Brexit or not in January, because some parties say they will cancel Article 50 and just cancel Brexit, really. Others say they want to get it done, but will it get done by January? We don't know. So let's see what happens, and we'll know certainly by Friday who is in power and who's going to lead this country for the next few years. So final warning then, read all your agreements, make sure you understand them so that you're not coming back later on and saying, I didn't understand. And unfortunately, there's I've seen a lot of people just sign even mortgage agreements without even understanding them. And did you know there are 200,000 people now stuck in mortgages they can't get out of? They're stuck on fixed rates of, say, 6% that they can't get out of. Lenders are not really playing fair with them. But again, it's all about really understanding where you're going with these mortgages. So that's my book, Yes, Money Can Buy You Happiness. You can get it on Amazon, maybe a nice Christmas stocking filler. So thanks for listening, and bye for now.